Welcome back to the channel. I'm Foreman, and in this video I'm going to show you 3 UK stocks to buy now in November 2021. One of these stocks I've actually been purchasing in my own portfolio, which you can see on the channel, and I've also got 2 other stocks, one that could be quite a speculative but good recovery play, and another one that I think is going to be consistently at a premium for the future because I think it is of a very good quality. And if you like the video, please drop one of these to help beat that YouTube algorithm. It is much appreciated. Today I've not done any screen or looking for any particular stocks. Instead, I've just been trawling through the markets. I've been looking at various news articles. I've just been taking into suggestion by interacting with the community on just some stock ideas. So I've not particularly looked for a specific set of stocks like I had last time with the screener. This time it has all just come to me naturally. I've not been actively searching for these stocks aside from the one that I have been buying in my portfolio. The other ones are interesting and ones that I think have potential, but I'm not too sure. So without further ado, I'm going to jump on to Simply Wall Street. The first stock is the Hut Group, or THG. I believe they may be changing their name in the future, and so this may not refer the same stock. But basically, this is the online retailer and technology company in the United Kingdom. They retail, I believe, beauty products mainly in particular, and a few nutrient-based products. I think they have like something called My Protein, although I could be speculating. The interesting part about THG is that you've got 2 main areas. You've got that whole beauty, you've got that nutrients whole bit there, and you've also got the tech-based bit called Ingenuity. Furthermore, we've got Softbank, who are a Japanese institution investor, I should say, and they have a 9% stake in the Hut Group. They've also got an option to purchase 20% of Ingenuity. So obviously, if they do decide to split off, then Softbank would be a good place to really buy that and help, obviously, fund it. However, there are some concerns about that I will address later in this video. So as you can see already, you can see the market cap is £3 billion. This is likely a little bit out of date, but that's simply Wall Street for you. Furthermore, if you look in the last 7 days, the stock is down 28%. So immediately you're going to be thinking, right, what is going on? Are earnings down? Because usually you might have a profit warning. Could that be why? Well, when we look at the past performance, this is not really the case. The basis of this is that yes, revenue is growing considerably. That is the main thing for this investment, and yes, their negative cash flow isn't improving, neither is their earnings. The whole idea behind this is that they are trying to push for profitability, and this is likely why they IPO'd, I believe, in September 2020. At that point, though, they had a valuation of, I believe, £5 billion, if not more. So it is quite interesting to see that this one has certainly hit a turn. But when you think about the valuation in terms of a price to sales ratio, the Hut Group is actually a very attractive business. With revenue of £1.9 billion, it's only a 1.5 times price to sales. However, it really is the earnings that are a big concerning because obviously they are unprofitable, and so you're not really getting any earnings per share that are underlying. And it doesn't look like, at least at the moment, that seems to be improving. So naturally, we should look at the balance sheet, I believe. This is where we're going to find, can the company continue to survive despite being unprofitable, and what protects us if we were shareholders from further share dilutions perhaps would be the cash on the balance sheet. So when we have a look, we can see that the debt has been reducing. That's good. They've got a 28.8% debt to equity ratio, a bit higher than I would like, but not bad by any means. But their cash is above their level of debt, and they have £878 million of cash sitting on the balance sheet. This is likely from their recent IPO, and that would have generated a lot of cash. This means that if we look at their past performance and we look at terms of their cash runway, they're losing about £500 million a year in terms of negative earnings. We're looking at the idea that this company could survive 1.5 years, providing they are unable to improve that earnings situation. Another concern about this company, though, was that the CEO/chairman himself had a golden share. This means he could veto any potential hostile takeovers and gave him a lot of power, which could lead to concerns with governance. And I believe that is the main reason as to why this stock is dropping. When we look at the ownership of the company, we can see that obviously individual insiders are a high portion, 16.4%. The chairman and CEO himself, Matthew Moulding, has got a stake of 14.99%. This makes him a very rich man, and skin in the game is usually a good thing. However, we do want to be careful. He is taking up 2 roles here Is he able to fulfill this role, or is he going to become distracted? Is he going to lose his purpose? Obviously, we do have a board of experienced tenure, but then again, we still are, that leads to uncertainty, and uncertainty isn't a great thing in the markets. So as we can see, in the last month, shares are down 55%. Furthermore, you can see how the news articles are saying there's a lot of pressure. And if we look at the Financial Times, the shares are continuing to tumble despite them actively looking to improve the governance. They've now said, look, I'm going to get rid of this golden share. They're going to improve it. And this stock could potentially then be eligible for the likes of the FTSE 100 in more of a distant future now that their valuation is far lower. Ingenuity itself, the technology behind the e-commerce transactions, was supposedly valued by Softbank investment as £4.5 billion. This leads to less confidence because investors may be a bit surprised to see that the current stock is only worth £3 billion, and that's including their profitable and that's also including their nutrient part of the business. And whilst the growth in Ingenuity is actually quite strong, they've had a 44% improvement in their revenue, but it's only up to £51 million, which is completely insignificant when compared to the total revenue. It is certainly going to be a concern for investors. And I believe that they've not actually released the earnings of Ingenuity itself and stuck it together as a business. So we don't really know how unprofitable Ingenuity actually is. I think the Hut Group is an interesting investment that could be a possible swing trade. At the moment, valuations are pushed down, but at the same time, you could be catching a falling knife if trying to invest in this stock. I personally wouldn't touch it, but it does interest me, and it is certainly a highlight for those that do like to jump in on the beaten up shares, the ones that have dropped by the most. I personally don't like to invest in this type of stock because I feel that I'd rather invest in a company that knows and is consistently making money, or at least they've not got their issues that are as large scale as that, and so they can continue to build on it and continue with what's successful. With this company, you're betting in the ability of the management, and unless you know more information than others, it may be a difficult bet to make. And if you'd like to sign up to my stockbroker Freetrade, you can actually get a free share worth up to £200 when you use my link in the description down below. The next stock on the list is one that I have been buying in my portfolio. This is Dunelm Group. You might go, why Dunham Group? What makes this retailer so special? And I'm sure you know that they retail homeware, furniture, the likes of that. You might be thinking, well, surely the high street's dying, right? So isn't Dunelm going to follow suit? I completely disagree. Dynamo Group is a very special situation because they buy up older warehouses. Typically, they have got leasehold warehouses, and so this obviously means that at the moment they've not got many freeholds. This allows the company to be more flexible. Flexibility is a very good thing at this moment. In the last year, they have bought and acquired one more store and made 2 relocations. Relocations are going to be of a lower cost because they have a majority of leaseholds. Dynamo Group is interesting because they have a good split between online sales and also in-store. Their online sales are a great way for growth. This is how they managed to do so well in 2020 because of this. And I think it's particularly interesting. And in fact, I think this is probably the optimum business model. You would like to have some high street stores, maximize profitability, or in the case of some online retailers that are already making a lot of capital, they could use their stores that are in very popular locations, like very busy high streets, as loss leaders to really promote the brand further. I don't know if that would be a really cost-effective method of doing it, but they could even break even, I'd imagine. But that's me speculating anyway. Dunham Group, I think, has less likelihood of being competed against. I feel that Amazon would really struggle to deliver big furniture items. This means that Dunelm relatively has its own space and it does its own thing. It also buys warehouses, obviously, that are out of town, not in the prime or more expensive real estate area of the high street. They add to their own communities, they have plenty of Facebook pages, and they are regularly giving back, like their Gifts for Joy campaign that they usually do, at least they have done for the last 2 years, around the Christmas period. That Gifts for Joy campaign is really not going to impact the overall revenue and earnings of the business, but it is very interesting to see because it is obviously once more throwing their brand out and also getting them more recognition, but also building that important community. Their past performance is very strong. This is a retailer that is valued at £2.7 billion. We can see that in this time, their revenue has gone from about £780 million at the end of 2014 to around £1.3 billion. So their revenue has nearly doubled in that time. earnings you can see actually are relatively flat. Overall, they are definitely up, but obviously the CAGR of their earnings is only 7.6%. I feel that in the future, though, this has a little bit more growth potential. But then this stock isn't for those that are after high-octane growth stocks. I see this as a valuable dividend stock. The dividend is currently yielding less than what it shows on Simply Wall Street. This is because they regularly give special dividends. They had done so in the last year and that really bumped it up. However, we're looking at a dividend yield approximately, I don't know the exact figure because I forgot that Simply Wall Street was wrong, but I believe it's roughly around the point of 2.6%. And this is a strong enough yield. Obviously, it's not amazing by any standards, but it's a good amount and you're paying for a higher quality company, hence why the valuation may seem a little bit higher than typical in the industry, especially when you look at it from a price to book ratio. Really what makes Dunelm a fantastic investment is their financial health, truly. They have a flawless balance sheet with no debt and £128 million of cash. Don't forget, they're doing regular special dividends, and with that cash available there, they're going to be doing more. Yes, their capital expenditure in the last year was lower. They look to double that, that would be roughly £40 million a year. That capital expenditure means that there could be more growth if they're opening more stores, more growth typically. And so we need to look at really the non-established stores to see how well they do over the longer term. It also gives them a lot of control should they wish to buy more stores whenever needed or even upgrade their e-commerce capacity, which is such a relevant thing at the moment. The management is very much a star player. Nick Wilkinson, you may or may not have heard of. Dunelm has quite an interesting startup story. I believe they were literally a stand in Wembley, just selling furniture. I imagine it would be rugs and mats. Now they are a massive company in the UK that are spread out across the UK with many warehouses and I believe up to 192 stores. Don't forget also inside their stores they have cafes too. So it really builds to that whole community and really builds up revenue. The staff themselves are typically very friendly as well, very helpful, and they have noted that on their investor reports. In terms of their last update in their trading, their first quarter trading update is very strong. A lot of companies have been comparing to 2019 growth because obviously if you were shut for a lot of the year, you would do so because 2020 wouldn't be accurately representative. However, their online sales did very well in 2020 and so their overall sales had grown quite considerably. I do like that their total sales in the last year or year over year has grown by 8.3% because the full year of 2020 was a fantastic year for the company and it really gave them a lot of capital. They realized how strong their online sales were and now their online sales take up, or their digital sales take up 33% of their total revenue, which is very cool to see. And you can see how it's grown by quite a considerable amount, growing from 14% or up 14% from 2 years ago. I see this as a valuable stock to buy for the dividend income. They're going to be growing regardless. They're a company that seems very stable with a strong moat because the competition may struggle to jump into the industry because it has higher barriers to entry. It's quite difficult to really retail furniture, especially on a larger scale, and I really doubt that people could really make it that successful from a market stand in this time and place. Naturally, this is in my SIP portfolio where I invest in dividend stocks. If you're interested in that, there will be a card at the top right of my video where I show my entire portfolio holdings. Dunelm Group, I only hold a very small amount of shares in overall, but in terms of my SIP portfolio, it currently takes up around 40%. The other stock on this list is the likes of Creightons. Creightons is a developer and manufacturer of toiletries and fragrances in the UK and internationally. I do like this stock, although in the past performance, they have certainly shot up in the last year. And I know that's not really one for value investors. However, their market cap is only £69 million, so they could have a lot of growth potential in front of them, especially when you look at their past performance. Their CAGR of their earnings is 34.4%, meaning their earnings has grown by that much each time. And when we go back a few years, we can see that their profit margins have also been scaling and growing faster than the growth of their revenue, which states the idea that as they're growing revenue, as they're growing their total sales, they become more efficient, they become maybe larger with scale, and that scale allows them to cut down costs, and they have higher profit margins. Already a very good sign to see. And their revenue in this period, in the last 7 years, end of December 2014, their revenue has over tripled. Their financial health is a good quality too, 14% debt to equity ratio and £6.5 million in cash, meaning that roughly 10% of their overall market cap is held in cash, and they've got only £2.8 million in debt. They do have a dividend, although this is probably not why you'd invest in this company. This company is of a higher growth, and so you wouldn't really want to be invested for a 0.64% dividend yield, and it could be very unstable. The payout ratio, however, is a low amount of only 10%, meaning that they have got room in the future to dramatically grow this dividend should they choose to. However, I would much prefer if they personally reinvested a majority back into their growth potential. In terms of ownership, we have got quite a breakdown. There is a few individual insiders that of a few different names like Bernard James Johnson and William McIlroy. These are totaling holding 26.9%. That is very strong skin in the game, and it would be unlikely to see a lot of shareholder dilutions, especially if the CEO, well, I'm guessing it's the CEO. The CEO has a 2.59% stake, especially if they have that much equity in the company. They're going to be looking to build it and grow it. And I think their valuation is quite fair. In fact, they're lower than the overall market, and perhaps this is because they've not really shown their true potential. Yeah, they've had some good growth, but the market may be a bit uncertain on their future. Are they going to be able to continue to grow? And that's the real question you need to be asking yourself if you were interested in purchasing shares of Creighton's. Unfortunately, Creighton's is a tough one to get, and at least with Freetrade, which is my stockbroker, you will likely not be able to purchase these shares, but they are certainly available. And with these smaller cap stocks, you do need to be careful of liquidity. Creighton's itself seems like they have a fairly good amount of liquidity in terms of the charts. However, there could be a spread that I haven't looked for, so do be careful of that also. Thank you for watching this video. I hope you enjoyed it. And if you're interested in my free UK stocks to buy for the last month, then click the card at the top right of the video. Have a fantastic day.